What if history isn't just rhyming? It's repeating word for word. The same debt, the same empty promises, the same ratings that lied before are lying again. The doom loop may already be spinning.
What is the absolute truth about 2008 versus 2025? Is the infamous doom loop repeating, this time tearing through the very foundation of commercial real estate?
We are witnessing a financial event that eerily mirrors the dark, chaotic days of 2008, but the epicenter has completely shifted. The fuse has undoubtedly been lit, yet the vast majority of the public is looking in the exact wrong direction, waiting for a housing crisis that isn't the real threat.
While the entire world nervously braces for a catastrophic residential housing crash, analyzing suburban mortgage rates and home prices, where is the real multi-trillion-dollar financial time bomb actually hiding right now?
It is hiding in plain sight, towering directly above us in the glittering skylines of our major metropolitan cities. The true crisis isn't happening in suburban cul-de-sacs. It is rapidly accelerating inside millions of square feet of completely empty, echoing office buildings that dominate our urban centers.
Are these buildings just experiencing a temporary dip in occupancy? Or how profoundly empty are America's office buildings right now? And is the trend actually getting worse?
The statistics are staggering. Nationally, 1 in 5 office spaces is sitting completely empty, hitting a record 20.5% vacancy rate in late 2025. In major tech hubs like San Francisco, the devastation is even more severe, with vacancy rates soaring past an unprecedented 36.7%. If these massive multi-million-dollar skyscrapers are sitting completely empty month after month, what is happening to their actual real-world market value?
Valuations for older office buildings have plummeted by 50 to 70% nationwide. The reality check is brutal. San Francisco's 350 California Street recently sold for just $68 million. That represents a catastrophic 72% decline from its peak value in 2005.
Why should the average person walking on the street care if wealthy commercial real estate developers and billionaire landlords lose money on their investments?
Because this collapse triggers the dreaded urban doom loop. When commercial building values crash, city property tax revenues completely evaporate. This forces municipalities to make massive, desperate cuts to essential public services, public transit, and safety, which in turn drives even more businesses away.
When we talk about a systemic threat, just how massive is the commercial real estate debt market today compared to the subprime housing bubble that caused the Great Recession?
The numbers are chillingly identical. Today's commercial real estate loan market holds exactly $4 trillion in debt. That is the precise peak size of the subprime mortgage market that brought the entire global economy to its knees back in 2008.
In 2008, the crisis truly began when everyday homeowners stopped paying their mortgages. Is that same wave of defaults happening right now in the commercial real estate sector? Yes, and the numbers have crossed a terrifying threshold. Commercial mortgage delinquencies have officially surpassed the worst days of the 2008 financial crisis. By August 2025, commercial mortgage-backed security office loan delinquency rates reached 11.7%, eclipsing the previous historical peak of 10.7%. What is the specific, unavoidable economic trigger forcing so many wealthy commercial landlords into default at this exact moment in time, rather than 2 years ago?
The trigger is a massive, unavoidable maturity wall. Between $957 billion and $1.2 trillion in commercial loans expired in 2025 alone, with almost another trillion coming due in 2026. Unlike 30-year fixed home mortgages, these are short-term loans that demand an immediate reckoning.
What actually happens when these corporate landlords are forced to refinance their massive expiring loans in today's drastically different economic environment?
They face an absolutely impossible equation. Borrowers who previously secured ultra-low interest rates of 3 to 4% are now being forced to refinance at new rates of nearly 7%. They are being asked to pay double the interest on buildings that are now worth half as much.
If a massive wave of defaults hurts everyone, can't the banks simply give these struggling landlords more time to pay off their debts, hoping the market recovers?
The era of extend and pretend banking is officially dead. Regulators are forcing banks to recognize reality,
leading to a record 13.8% distress rate on short-term floating-rate commercial bridge loans. The banks can no longer hide the bleeding. The losses must be realized. In 2008, toxic subprime mortgages were packaged together into supposedly safe, top-rated bonds, deceiving the entire global market. Have we somehow repeated that exact same fatal mistake?
We have. The most terrifying parallel to 2008 is the return of the AAA lie. Wall Street once again packaged highly risky commercial real estate debt into complex securities, slapped a top-tier AAA rating on them, and sold them to global investors as virtually risk-free assets.
When the underlying office buildings actually fail and go bankrupt, how safe are these supposedly bulletproof, top-rated commercial real estate bonds proving to be?
The illusion of safety has completely shattered. In a landmark failure at 1740 Broadway in New York City, investors holding supposedly invincible AAA-rated commercial mortgage-backed securities suddenly suffered a massive 26% loss on their principal. The unsinkable bonds are taking on water.
If these top-rated bonds are failing and commercial landlords are walking away, who is actually left holding the bag for this $4 trillion crisis? While Wall Street mega banks packaged the deals and took their fees, the institutions holding the actual underlying loans are much closer to home. It isn't just the global financial titans on the hook this time. The vast majority of commercial real estate debt sits squarely on the balance sheets of America's regional banks.
Why are America's regional and mid-sized banks uniquely and dangerously vulnerable to this unfolding commercial real estate disaster?
Unlike diversified global megabanks that have revenue streams from all over the world, regional banks are heavily concentrated in local commercial property loans. As these localized, urban office markets collapse, the regional banks absorb the direct, concentrated impact, threatening their solvency and choking off their ability to lend to everyday small businesses.
Looking at the empty skylines and the staggering debt, what is the ultimate truth about 2008 versus 2025? And is the doom loop truly repeating?
The most terrifying parallel between 2008 and 2025 isn't the housing market, it's the return of the AAA lie, where top-rated commercial real estate bonds are suddenly suffering massive 26% principal losses. While the world braces for a residential housing crash, a $4 trillion time bomb is hiding in plain sight inside empty office buildings. Driven by a massive $1 trillion maturity wall and record-high vacancy rates, commercial mortgage delinquencies have officially surpassed the peak of the 2008 financial crisis. However, this crash won't be a sudden global heart attack. Instead, it is an urban doom loop engineered to slowly wipe out America's regional banks while Wall Street escapes relatively unscathed.